Hey, welcome back. Today we're going to look at different exchange rate policies that governments may choose to pursue. What we want to do is be able to describe the difference between a fixed exchange rate and a floating exchange rate, and be able to explain how an exchange rate can actually be fixed, and provide some reasons for why a country would choose to pursue either the fixed or floating exchange rate policy. So all this information is in Chapter 34 on the pages listed on the slide. So there are two different exchange rate regimes that your country could pursue. The first is what's known as a floating exchange rate. And with a floating exchange rate, the exchange rate between your currency and other countries' currencies is set by the market, and it's based on supply and demand, and it either goes up or down depending on what the market decides the appropriate exchange rate price ought to be. The government is not involved at all in determining what the exchange rate will be at all. They just leave it to the market and deal with the consequences. The other option is what's called a fixed exchange rate, or you peg your exchange rate. And in that case, what happens is there is a target set by the government. So the government determines that the exchange rate should be $2 for every euro, and whatever the target is that they decide. And then they will then intervene in the market to make sure that that target price is always met. And so there are a variety of policies that governments can pursue to make sure they get the exchange rate that they think is most desirable. The decision on which policy regime to pursue is important because it has an impact on the country's overall balance of payments as to whether or not they're going to be a net exporter or a net importer, depending on the relative strength of their currency to their trading partners. And so governments really do care a lot about which of these two regimes they're going to choose to follow, and there are pluses and minuses to both. So let's pretend for just a minute that there's a country called Maditopia, and they have a currency known as the hawk, and they trade with the United States. And so we could look at the foreign exchange market for the Maditopian hawk relative to the US dollar, and we could see that in this case the market says that the exchange rate should be $1 per hawk. But we could also then see that if Maditopia wants to set its exchange rate, fix the exchange rate at $2 per hawk, then we see that there is now a surplus of hawks in the foreign exchange market, because at the price of $2, the people holding hawks are more willing to trade them than people in the market looking for hawks are willing to pay for them. And so there is an extra surplus here of hawks in the foreign exchange market. So the fixed exchange rate would be $2. If we were doing a floating exchange rate, then it would be $1. So if there's a surplus of hawks in the exchange rate market right now, then Maditopia needs to follow some policy or policies that will eliminate that surplus and bring the market back into equilibrium at the price that they desire. And so there are several options that the government could pursue. One is that they could just buy up the excess hawks in the market, and in order to do that, Maditopia would need to use its reserve of US dollars. So each country carries its own reserve of foreign currencies, and if they're going to be involved in a fixed exchange rate regime, then they're going to need to use that foreign exchange reserve to then buy up any sort of excess supply of their currency that may exist in the market. And so by buying the excess hawks, it would shift the demand for hawks to the right, and that would cause an increase in the exchange rate. So by buying the excess supply of hawks, the demand will shift. We'll move along the supply curve to a new equilibrium point of $2 per hawk, which would then put the government at the exchange rate that it wanted to have in the first place. They could also then try and just shift and manipulate the supply and demand of hawks. And one thing they could do is then they could raise the interest rate. So Maditopia's central bank could go about and decide to sell government securities, government bonds or T-bills. By selling those bonds, they are taking money out of the money supply and causing interest rates to rise. And what we learned a couple weeks ago is that if the interest rate in one country is higher than the interest rate in another, that capital will begin to flow into the country with the higher interest rate, which means then that in order to invest in Maditopia, investors from the United States will have to buy Maditopian hawks in order to invest in the country. And so we would see then an increase in demand, just like when Maditopia itself decided to buy up excess hawks. And in either event, we'll see the demand shift to the right, and we'll see the price of hawks, dollars per hawk, rise and get to the point that the government wanted to set the exchange rate at. A third option that Maditopia could pursue would be to limit the ability of people to sell hawks in the foreign exchange market. So if you limit the ability to sell hawks by requiring a license, for example, to be able to sell them, then what happens is that there is less supply of hawks. It's reduced. And so supply would begin to shift to the left because there's just not as many hawks in the foreign exchange market, because there just aren't that many people that have licenses, because the government has determined how many licenses it's going to send. And so we would then see a left shift in the supply of hawks, which would also then cause an increase in the price. In this case, it's a reduction in the quantity of hawks, but that doesn't matter as much as the government getting the exchange rate that it's decided that it wants for itself. And so that would be another way to achieve their fixed exchange rate goal that was set by the government. The result of this appreciation of the hawk then should be that Maditopia, because its currency now is more powerful than it was before, it's appreciated, then Maditopia should become a net importer. They'll begin to import more goods from overseas, because U.S. denominated goods are now relatively less expensive, which means that their current account should shrink, but their capital account should rise, because we're seeing an inflow of capital in the pursuit of higher interest rates, and so the balance of payment should even out. So we should see that as a result of this particular policy being implemented. So what are the positives and the negatives of fixed exchange rates? On the positive side, it creates a degree of price certainty. So there's not this fluctuation. The value of your currency will always stay the same, because you're constantly working to manipulate the market to keep the price exactly at whatever the price is that you've decided you want it to be. And so basically it means it's similar to being able to use the dollar in other states around the country. Like, everything is the same price basically no matter where you go, from day to day. But if you're not in a fixed exchange rate system, then goods prices can swing wildly depending on the exchange rate on a given day. It also helps to stabilize central bank policy. The central bank is essentially limited in how it can pursue macroeconomic goals. They cannot pursue a policy of inflationary spending in order to increase aggregate demand, because if they do that, at least in this case that we just talked about, that would lower the price of the hawk and would be self-defeating. So you can't just go out of your way to purposefully depreciate your currency in order to increase your exports, or inflate it if you decided you wanted a strong currency and do that out of the blue. You have to have a consistent, cautious central bank policy if you're going to be in a fixed exchange rate regime. The downside to a fixed rate exchange system then is that you have to carry a lot of foreign currency. So you got to be sitting there holding on to other countries' currencies, which has a very low, if any, actual rate of return. So you've just basically got dead money sitting there waiting to get used to keep your exchange rate at the level the government wants it to be. And even then, you may not have enough money in your reserves to actually get the exchange rate that you want, or keep it at the level that you want to keep it at. And you also have the issue that you lose out on the ability to use monetary policy to dig yourself out of a hole. You have to use your monetary policy to keep your interest or your exchange rate at the level you want it to be. You can't then use your monetary policy to boost the economy, because as soon as you do, you're going to see a change in the exchange rate, and you're going to have to either undo the policy to get back to the former exchange rate, or give up the idea of a fixed exchange rate, which is what you didn't want to do anyway, because you were in a fixed exchange rate to begin with. So it does hurt your country's ability to use monetary policy to control economic output. We'll work a little bit more on these concepts, and we've got a problem set to work on when I see you in class.